Yeah, good afternoon, everyone. Thank you for all taking out time today. Uh, I would request everyone to mute yourself in case someone is unmuted, so that there is no disturbance while we are, taking through the today's webinar. So, before we begin, I just want to introduce about me and about my firm. I'm Manish Saraf. I'm chartered accountant into this audit and tax advisory services for last 20 years. I've been associated previously with PwC Deloitte and last 8 years in UAE. Been SNB Consulting has primarily been working on different tax advisory, corporate tax and transfer pricing, and we do other risk advisory services and technology consulting. With me is Prakriti Dangi, and she also carries 12 years plus experience working with previously been associated with PwC and specializes in international taxation and transfer pricing. So that's about us. And today we are going to talk about what are the year-end financial readiness requirement to align with the corporate tax return filing. Once the corporate tax return format is already announced, and now people have started closing the financials and being ready for the return filing. And as we see that most of the companies have the financial period January to December, and 2025 will be the first
विजय जी
tax
आपको
period
डिस्टर्ब हो रहा है तो मैं उधर जाएगा
we will be filing the return. Mr. Hitesh, if you can mute yourself. Yeah, thank you. So we're going to talk about different provisions which are applicable for the financial preparation and what adjustments would be required when you are closing your financials. So we're going to talk about the accounting record keeping requirement in terms of what are the requirement of financial preparation, and as per the corporate tax return, what are those taxable persons and how do we, what are the informations required to be submitted in the return, and specifically elections which are to be considered to be taken up. And while we are preparing the financials, we need to know, we need to assess at that point time of financial preparation itself that what are the different elections we are going to opt when we are submitting the return, and the adjustments which are to be done prior to closing of financials, and something which will be adjusted while we compute the tax liability, and what are the tax losses relief which can be carried forward or adjusted within your group entity, and then the transfer pricing elements or the detailed schedules which need to be submitted, and how we compute and arrive at the arm's length documentation. So if you see overall, the way we start when we prepare a tax computation, just a background, so that we need to understand that what goes into the tax computation, and accordingly we are aligned ourselves in the financials with that. So we reduce the exempt income, and then certain expenses are deductible, non-deductible. So that accordingly our chart of accounts in the financials are aligned to that. Certain, like, if you see deductions are not eligible, are fines, penalties, or donations which are specifically limited to qualifying fees or qualifying benefit entities, and then other adjustments within the group entities transfer taking place within a qualifying group, and then the losses which can be set off, and then we derive the taxable income, and and then certain investments which are outside UAE, and you pay a tax outside UAE, then the tax credit which are received here. So how those need to be accounted in your financials. Yeah, so as we are going through this, you
Give
can
me
put up
five,
your questions.
45 minutes. Tamil is there. I'll
Yeah,
come.
please, Mr. Mayur, can you mute yourself?
Sorry,
And
sorry.
yeah, please, thank you. And as we are going through it, please put up your questions on the chat box, and then what we will do, we will run through those questions and discuss about different scenarios. And the whole purpose is that we need to understand the practical scenarios which you would face, and let's talk about some of them in this webinar today. So this is how the return looks like, the taxable person information which comes from your corporate tax registration details, and different elections which need to be done with respect to your realization basis, transition provision, some elections which need to be carried out. But before we are closing the financials, we need to assess that whether you're going to opt for, whatever specific elections are. Then accounting schedules, which is basically the details need to be submitted in the return, the adjustments which need to be carried out while computing the tax liability, and then reliefs which are eligible, in terms of business restructuring or qualifying beneath entities transfer and other adjustments, and then tax credit. So these all details are important to understand because this will help us to be better preparing our financials accordingly. As we know that the tax return filing period is 9 months from the end of the financial period, which is mostly Jan to December. So it is September 2025 is the return filing period. But now we have seen in some of our clients where they have been receiving notices to file return before that because I mean, they would have started their financials in between the period of, like, say, they would have been incorporated in mid of 2023, and they are exceeding more than 18 months. In that scenario, authority have issued them asking their submission of return even until before December 2024. So, and the first deadline was December 2024, and some of our clients, you see, they have not submitted that. They are getting penalties of fines of 500 dirham per month. So you need to be careful that, if you would have received any notice from your FTA regarding filing of return, you make sure that that return is being filed within that period. But mostly, if it is Jan to December cycle, then this September 2025 is going to be the first tax period when you are going to file your return. And then this is going to be through the Imara tax portal as we have been doing for VAT. Similarly, through Imara tax portal, the return has to be filed, and the taxable person information is automatically populated once you enter the taxation. You log in with that. You'll click on the tab of corporate tax return filing. Then the taxable person details what we have registered during the registration. It will automatically pop up. And then there are certain schedules which are there in the corporate tax return, which are only visible, like, once you click particular option, like if you're opting for small business relief, then there's a detailed schedule, or if you are going to opt for qualifying free zone benefit, then the detailed schedule which follows on that. So now the basic need to understand what are the accounting record keeping you need to maintain when you are going to be preparing your financials. So, as per the corporate tax regulation, it is either the cash basis of accounting or the accrual basis of accounting. So, the cash basis of accounting is applicable in case the revenue is not exceeding 3 million. And when I mean to say cash basis, that means you are accounting you're going to report your income basis what you would have collected. You would have invoiced to your customer, but suppose you have invoiced customer like 50,000, but you have received only 30,000. So you'll be showing as your revenue, your income as 30,000, your sales as 30,000, and corresponding payments, whatever you have done, will be deducted. So only on cash basis, the accounting is done. But most of the entities whose revenue are more than 3 million, they will be following the accrual basis of accounting. And the accounting standards that applies to all of the entities who are having the UAE, and so it is IFRS is mostly applied. But in case of companies which having a revenue less than 50 million, they can go for limited scope of IFRS, which is small medium enterprise, IFRS for small medium enterprise, where certain provisions of full IFRS scope is not applicable, but only when the revenue of that company is less than 50 million. But if it is more than 50 million, the complete full scope of IFRS is going to be applied. And in case of tax grouping, for filing the return, you need to have a consolidated financials. If there are ABC company under a parent company P, then all the financials of ABC has to be consolidated. But of course, ABC would be still preparing their own standalone financials for their respective profitability, but for the return purpose, it need to be consolidated and filed. So you need to prepare that. You have to prepare individual financials and as well as the consolidated financials in case of tax grouping. Now, the record keeping, which is mandated under the corporate tax regulation, it is 1 + 7 years, the current year, that is 2024, which has just been. So for 2024, you will keep it, and for next 7 years, you will be maintaining that. So that means 2031 until the next 7 years. Total is 8 years. You need to maintain the records of your financials. And mostly we suggest our client to have those records in a software, it could be any Tally, Zoho, or any accounting software, so that the records are maintained. And then in VAT, we have seen that it was 5 years, but in corporate tax, it is 8 years in total, considering the current year as well. And then the audit requirement is if you exceed a limit of 50 million, then you have a mandatory audited requirement that your financials need to be audited, and those audited financials will be uploaded in your tax return. And in case of course, if you're applying for a qualifying free zone benefit, then you need to also get your accounts audited. And in case, there are certain penalty provisions where you don't comply with those documentation, which varies based on the kind of penalty provisions of non-compliance for record keeping or accounting, which is 10,000, 20,000. It varies depending upon the specific non-compliance. And then in terms of basic record keeping, which need to be there, is your P&L, your balance sheet has to be there, the financial statement has to be there, your all the records supporting of all the transactions being posted in your financial, they need to be well supported with that. So like your wages and salaries or fixed asset which you have purchased, the records of those fixed assets being purchased, or any inventory stock movement happening in the purchase records, the invoices has to be maintained and supported, because I mean, FTA can ask based on any specific audit requirement, they can pick up any sample of entities and ask for those records, which you have, because your financials are going to be uploaded. They have access to your financials, and then they can, once they do an audit later on, they may ask for supporting documents. So that need to be available. And in case some of the entities who visit, who are maintaining the financials in other than other than AED, then maybe in dollars or other currencies, that need to be converted. The financials need to be converted in AED, considering the central bank rate while you upload it. So those financials has to be in the AED and to be uploaded in the tax return.
سمعت منهم
And yeah, please mute yourself. Then, in terms of the some minimum documents which would be required when you file the return, and that's what is important, that you have those documentation put in place. First is the financial statement is mandatory. The financial
इसको
statement, as
बोले
I
तो ना ज्यादा
mentioned, consists
बोले
of
कम
income.
इसका कि लंबे लाख
Please mute yourself.
Mr. Mayur, could you please mute yourself?
Okay. So some of the mandatory documents which are required is financial statement, which comprises of your income statement and balance sheet. So you need to have a proper account records being maintained, because these financials will be uploaded in your tax return. And in case someone who goes for small business relief that is less than 3 million benefit, those are the one who might not be required to have those financials uploaded. But in almost all of the cases, financials need to be uploaded in the tax return. And specific documents with respect to the market value of financial asset and liabilities would be required. That is, if you have assets in terms of land, building in your financials, you need to get the market value as of 1st January 2024, because there is specific transition rules where you benefit that any gain you make after the first tax period, that is not tax. So the prior to the taxability is only with respect to the when the corporate tax is applicable from 1st January 2024. So for that matter, you need to have the market value, because based on that, you will compute your tax liability on the gain which you make. So the specific transition rules, you need to have that market value. And then in case if the entity has a presence outside UAE, then in that scenario, if they are paying tax in that entity, they need to have this documentation. Like if you have a presence in Saudi, you are paying tax there. So withholding tax or whatever, you need to collect the certificate, and because you're going to get a credit in UAE for that matter, so the documentation of tax paid outside UAE need to be maintained. And also similarly for tax residency certificate, if you are paying tax in other entity outside UAE, then tax residency certificate would be also required. Now, with respect to the taxable person, this is just a background in terms of, as we have seen, that it's classified under resident and non-resident, and under the resident you have either you've been incorporated in UAE mainland free zone, or there could be a scenario where you have entity outside, any business outside UAE, that it could be in Singapore or Saudi, and it is being controlled and managed from here. So decision making is taking place for those entities in UAE. The directors or the owners sitting here are resident in UAE. In that scenario, any income earned from those entities, like a garment trading, could be in Saudi as well as in the UAE, and the decision making is done in UAE, then it gets taxable in UAE. So that need to be declared when we file the return, and the registration is required for those. And I'm sure that all of you would have been registered by now. And in case of natural person, it is only when he conducts a business activity, and some of the activities which are excluded are your salary income. If an individual earning salary income, that is not a taxable. And in case of your real estate businesses which you have, that is not taxable, or any investment activities which you carry out as like a share market trading, that is not taxable. So those are exempted category for a natural person. But as if he does a freelancing business or consulting business individually, that is taxable, and for which a person need to be registered. And non-resident is only when he having a permanent establishment in UAE, like a branch of India entity having a branch in UAE, need to be registered. Or in case having a UAE source income through an agent and is a dependent agent, then that is becoming registered. And having nexus in terms of having any immovable property in UAE, earning rental income from the immovable property in UAE are required to be registered. And all this registration is based on the trade license. In the month in which trade license has been issued, there is a deadline with respect to the date of the trade license. Now, I mean, irrespective whether you are making income or not income, no, even it is less than a threshold of 375,000, you still have to register. And we have seen now some of the companies are getting fine of 10,000 dirham because of the late registration, and there's a deadline from the date depending upon the date of trade license, and now they're getting a penalty of 10,000 for that. Now, when we see a tax return, the taxable person as are categorized in the tax return is a juridical person. When you fill up, you have the option. I mean, when you have registered yourself, you would have already categorized yourself, either you're a juridical person, natural person, or whatever. And then under the juridical person, you have resident, non-resident, and natural person similarly is classified non-resident, non-resident, and qualifying free zone person is because there is specific category in a taxable person return, because you get a benefit of 0%, and that separate category is defined. And tax grouping is scenario where you have multiple entities and you want to group them, but there's specific criteria based on which you can do a grouping. An unincorporated partnership is like a joint venture where the unincorporated partnership is not taxable, but the partner who are there are taxable. And that's the reason it's a separate category under the taxable person in the return. So just to on the tax grouping, what is the definition? You would have seen that earlier. It is 90% common holding, and they need to be a juridical person. That is a parent company. P is a juridical person and holding shares in B and C, which could be direct or indirect. So in the left-hand side, you can see it is indirect holding. Direct holding is in B and indirect holding in C. Still, the parent company can form the tax grouping. But it's important that there has to be a legal entity for creating a tax grouping. An individual holding in B and C will not be able to form that tax group. The legal entity has to be there to have a holding of parent and subsidiary relationship, then they could do it. And in case of any entities which are in mainland and do qualifying free zone, they cannot do a tax grouping, because a qualifying free zone person will be paying 0% tax, whereas the mainland entity is going to pay 9% tax. So because of the tax rate differences, they cannot form the grouping. And an unincorporated partnership, just to give a background, what is it like? It is specifically when you enter into a joint venture for specific activity, then you form a partnership. And unincorporated is not registered separately with the authorities. And in that scenario, the company A and B enter for a highway project or for infrastructure project, or like a real estate. Generally, someone go and venture together, fund those, and build up a real estate property, and they run it for some time. So that particular project can be through an unincorporated partnership, a partner A and B forming this project. As generally unincorporated partnership, like the partnership entity highway project will not be taxable. That project will not be taxable, but individually A and B will be taxable. The income they earn, it will be taxable in their individual capacity. But if you have applied for to be as a separate taxable person, in that scenario, that partnership can be taxable. When you have applied and FTA has approved that, then the partnership get taxable. Whereas, otherwise it is a taxable individually. And some of the information which get pre-populated in the tax return which comes from your corporate tax registration, is a legal name and tax period, and everything goes from while you registered yourself. And certain information which goes in the tax return is important to know that what are the critical information which goes in the tax return, and accordingly you prepare your financials. You reflect those numbers correctly in your financials. Of course, the business activities which goes from your trade license and it is entered while you registered yourself, and the revenue number which is going to be reported in your financials, that number has to be reflected. So make sure that numbers are correctly input and captured in the tax return, and the computation of your revenue is correctly, and it has to be as per the IFRS accounting standard, and percentage of total revenue allocated to each business activities. Suppose if your company has a facility management and a lease rental business, so there are two business line of it. So for facility management, whatever percentage, like it goes 40% or 60% is for a lease rental business, that has to be allocated and reported. And accordingly, that segment reporting or classification has to be done in your financials, also need to be identified, because that's how the authority will match those numbers with the financials. And in case there is an unincorporated partnership investment, like a LLC is having investment in a particular partnership, then it need to update the information about it, because a LLC will be paying tax on that particular partnership. Then, as I mentioned, that what a basis of accounting is followed, it is cash or accrual that need to be updated when you're filing the return. And if in case you have an entity in Saudi or anywhere else, and that is being effectively and controlled from UAE, then that information has to be updated, and you have to be mindful that will be taxable in UAE, but of course you get a credit of whatever tax is being paid outside UAE. And in case of you have a presence in the free zone, and after there are certain criteria based on which you become a qualifying free zone benefit only when you are carrying out those activities and you meet the substance and other requirement based on which you get eligible. So you need to assess yourself, when you're preparing a financial, you need to assess that are you meeting those eligibility criteria, and then only you opt and update that in the tax return. Now, certain elections which need to be done when you're filing the tax return and when you're preparing your financials, you need to be aware about it, that what are those elections which you will be considering in your tax return. So one of them is a realization basis. The concept of realization basis is that the authority don't want to tax you for the income which you have not actually realized, or realization means you have not sold it off and you earn that out of it. So maybe there could be an asset whose value is in the books is showing 100,000, and the market value of that asset has changed to 120,000. So the gain of 20,000 you would be showing in an accounting income, but you have not sold off that. So that 20,000 you have not realized. So the authority don't want to tax you on that 20,000. So that's the reason that this election has to be done, whether you want to be taxed on realization basis or unrealized basis. Now, if you have not opted anything, authority will consider by default as unrealized basis. That means the 20,000 gain which is arising for market value differential will be taxable. But if you opt in your tax return on realization basis, that means it will be only taxable when you are actually selling it off in the market. So that option you need to assess when you're preparing your financials, that whether you want to go for realization or unrealization basis. And it is irrevocable. That means in the first tax period, when you're filing a return, you opt it, then in the next future period, you cannot change that. So assessment has to be done during your financial preparation. And if you look at it, it is only applicable to the capital account. And in case of taxable person, if it is a bank or insurance, they can only go for capital account. Otherwise, other entities can opt for this in case their asset and liabilities are subject to fair value or impairment accounting. Now, what are those items of fair value and impairment accounting? It is like you have a financial instrument, is like something where you have invested outside entities. The value is changing. You are trading in the stock market or invested somewhere as an entity. The value keeps on changing, like the value could be today, the market value is 80,000, while your book value is 100,000. The difference of 20,000 is unrealized, and you will not be taxing on that. So you need to do an adjustment in your accounting in the tax liability computation. And either it could be on capital account, which are basically your plant, machinery, equipment, investment properties, intangible assets, non-current or long-term debts, which are there. All these can have for all these you have an option of realization basis. But when it comes to revenue account, those are like your trading stock account. For that, you will not be having a realization basis option because those are for short term and you actually going to realize it. So revenue account items are not considered. So here are certain examples, like a company who's having a financial assets, which is like an investment in other security market. The original cost of purchase was 250,000, but the value as of, like, say, suppose 30th April 2024 has gone down to 200,000. So the loss of 50,000 would be shown in your accounting income. It will be reduced in accounting income. But when you're computing your tax liability, you are going to add back this because this is a not deductible expenditure. Now, in case of a company which has a land whose value has, as of December 2024 has increased, while the original value was 50 million, the value has increased to 60 million. So in your book accounting income, you would have shown that 10 million, but when you're computing your tax liability, this will not be a taxable portion, which was already included in your accounting income. So you're going to reduce that in your tax computation. And now in case the third scenario is where company is selling laptops, handsets. Now due to a new technology coming in, the value of that particular laptop or handset has gone down. It has gone down by 100,000. So the stock is still there in your books. That 100,000 you are going to write off in your books, because the value has gone down. So now are you going to make an adjustment in your tax computation for this purpose? This will not be, because it's a revenue item. Revenue items are the one which are an operating trading items for which you will not going to make any adjustments. So that 100,000 which you have reduced is rightly allowed because this is an inventory item and it will have no impact on tax adjustments. Then certain transition rules. As I was mentioning at the beginning, that transition rules are applicable to benefit that authority doesn't want to tax you for any gain which occurred prior to the first tax period. And there are certain items on which it is, like in the first tax period, that is 1st January 2024, any gain prior to that will not be taxable. And those items on which they give benefits are financial assets and liabilities. Financial assets, as I was mentioning, with respect to any investments in any security market, or it could be debts or bonds, debentures, which are financial liabilities in your books. You will not be having any, taxability for the gain prior to the first tax period. Immovable property could be any assets, land, or intangible assets like copyright, patent, which are held in your financials. So the definition of qualifying is that these all should be qualifying. That means those should be held prior to the first tax period. Then only you would have you will not consider the gain prior to that. So if these assets should be on hold as on 1st January 2024. If this transition rule doesn't apply if in case you purchase some asset during 2024, because if since you purchased in current year of 2024 when the tax was applicable, any gain arising during that period will be fully taxable. But something which was held historically, that will not be taxable after the portion of gain will not be taxable after the 1st January 2024 for the historical period. So let's look at it, for example, of immovable property. Now, immovable property, the details generally are the details, address of the immovable property, that if you have a building, the address of that building, or the land building address. Example, it was purchased on 1st January 2020, and the original cost when you purchased was 60,000, and the net book value at the first tax period is 1st January 2024 is 50,000. Now, if you dispose of this asset during 2024, what would be the gain which would be taxable in 2024? So let's look at below scenarios. I'll give an example to it. And the adjustment when we do is based on the time portion method and valuation method. There are two methods which are considered for adjusting this gain or taxability in your tax return. And it depends upon the number of days. The time proportion method depend upon the number of days for which this asset was on hold. You have holding this asset because until 1st January 2024, the number of days which you are holding, suppose this was I was mentioning here 1st January 2020 was, when you purchase it, we count the number of days until 1st January 2024. So that number of days for which the asset was on holding, any gain pertaining to that will not be taxable. But after 1st January 2024, whatever gain is proportionately you earn, that become taxable. So here is the scenario. If you see on the right hand side, I'm given an example that you purchase the asset in 1st January 2020, the value was 60,000, and on 1st January 2024, the value is 50,000. So first is that either of it, whichever is higher, we'll consider 60,000 is higher, and the market value, when we consider the valuation approach, the market value as on 1st January 2024 is 100,000. So the gain which arises as on 1st January 2024 is 40,000. That is 100,000 minus 60,000. 40,000 is the gain. This portion of the gain will not be taxable. And then when you're actually selling it off, this asset on says 1st April 2024 for 120,000, then what you're going to deduct from this value of market value or sellable value 120,000, you will reduce the cost, which is 1st January 2024 cost 50,000. Then you will reduce the 40,000 gain, which is excluded, which is earned prior to the historical period, or that is prior to the 1st January 2024 will be reduced. The net amount which taxable in 2024 is 30,000. So the portion prior to the first tax period will be reduced. And similarly, in case of time apportion method, what we do, we consider the number of days from 1st January 2020 till 31st December 2023, that is 1461, and the total period of holding until 1st April 2024, which is 1552. So the gain proportionate to the 1st January 2024 will be removed, and the gain which is from January 2024 to April 2024 will be taxable in case of time apportion method. Now we look at the small business relief election is there. So what are those? You all would know that it is applicable in case you are having a revenue of less than 3 million in current and the preceding tax period. The first tax period is 2024. So if you see possibly that once you know this period is closed, December 2024 is closed, so you know that what is your revenue. And if it is less than 3 million, when you're filing a return, you have an option to select this small business relief. And but you need to assess, I mean, whether to opt for small business relief or not, because there are certain disadvantages of opting for small business relief. If you are not making any income from that particular business, and it is less than 375,000, and where you not be paying tax, you need to see whether, because you are anyway not going to pay tax because it is less than 375,000 of income is less than 375,000, or it could be in losses sometime, then you cannot carry forward that losses to the future period of 2025. You cannot carry forward that loss. So whether you should be going for small business relief, you need to see whether, because you're not going to get those benefits of carry forward losses or even net interest expenditure. If you have borrowed funds from the bank, the interest amount which you are paying it, those are deductible, but it will not be claimed when you are opting for small business relief or any exempt income which you want to read, want exempt income like dividend. If you have earning any dividend, those cannot be reduced from your taxable income. So those benefit you're going to lose out when you opt for small business relief. So you need to assess, see whether you want to make this option of election in your tax return. Now, qualifying transfer within the qualifying group, it is one of the election in the tax return. So you need to assess your financials, that whether you first eligible to be forming a qualifying group. Now, what is that qualifying group? In the bottom side, I mentioned it should be a juridical person, the ALLC, BLLC, CLLC. It could be any kind of juridical person, not an individual person cannot do, the natural person cannot form a qualifying group. And it could be resident person or non-resident, or even having a non-resident having a branch in UAE can form this qualifying group. And then the ownership stake has to be 75% in common to be eligible to form a qualifying group. So on the right hand side, the box which I made, like A LLC and B LLC having 95% stake, so they can form a tax group. But now when we see C LLC, where B LLC is holding 75% on C LLC, and indirectly A LLC hold 95% because ALLC is holding more than 75% because ALLC is holding direct 25% and BLLC 75%. So altogether, it is holding 75%. So it is an indirect. So all three can form a qualifying group, not a tax group, but tax group only can be between A and B because they have common 95% stake. Now, what is the benefit of having a qualifying group? Is that when you transfer any asset in between those company A and B or C, then there is no gain or loss. Like if you are transferring a building in the name of B company is transferring a building in the name of A, the value of asset, maybe whatever the book value is, it will be transferred at the same price to the LLC, and there is no gain or loss, so it will not be taxable. And then another critical point which need to be known in the case of qualifying group transfer is that it is irrevocable. That means once you opted in your first tax return, then in the next 2025 financials return, you cannot go and reverse that. So you need to be very careful whether you want to go for this option or not. And you need to assess in your financials. So here is an example. And if there is another clause is that suppose, ALLC on the right hand side in the box, ALLC transfers to BLLC on 1st July 2024. Net book value, particular asset is 800,000 and the market value is 1 million. So the gain of 200,000 is not taxable to ALLC because it is the same qualifying group. Now, BLLC who bought it who took it from ALLC in the year 2024 is transferring it in 2026 to any third party. BLLC is selling off that particular asset to third party. The gain which was not taxed in 2024 become taxable to BLLC in 2026 because there is a clause that if you dispose of that particular asset, if the group dispose of that particular asset to third party within the 2 years time, then in that scenario it get taxable. So it is a temporary relief which is given of the initial tax period, that it is not taxable, but if that is transfer is taking place in next 2 years time, then it get taxable. Now, another clause is election, which is there, business restructuring relief. So if during the financial period, if you have disposed of any of your businesses, say, suppose you are having a business of facility management and lease rental business. Those are two business units which you have a company like ALLC has this two businesses, and it's selling to BLLC, a separate entity, any of that business. So the transfer which is taking place and the gain which is arising is not taxable to ALLC. So if we see on the right hand side in the box, ALLC is transferring its business to BLLC. The value of the net book value of that particular business, say suppose facility management is being transferred to BLLC, and the net book value is 2.5 million, whereas the market value of that particular asset is 3 million. Now the $500,000, the profit which ALLC would make is not getting taxed, because this is transfer is taking place as part of the business restructuring relief. They have opted for it, and though they would not be a qualifying group. They should not be part of the same group. Doesn't matter whether it's being transferred within the group or not. That is not a requirement, but it is a particular business when it's getting transferred, and he has opted for business restructuring relief. Then it will not. The gain which is arising of that particular transfer is not taxable. But again, the clause is 2 years. If that transfer is taking place within the 2 years time, if that particular business was transferred in 2024 to someone else, and that the party like BLLC who bought it is going to sell it to third party in 2026, the gain which was not taxed in 2024 will be taxable in 2026. Now, another election is foreign permanent establishment. Now, what is foreign permanent establishment? Is like a company in UAE is having a branch in Singapore, and that is a foreign branch holding by company A in UAE. So, in the tax return, he has an option that he don't want to tax the income earned by that branch, Singapore branch. Okay, and it is only eligible to the entities who are paying the same tax as UAE. That effective tax rate which is applicable in UAE is also there in the Singapore. So 9% which is being paid in UAE is also being paid by the branch, which is a foreign permanent establishment in Singapore. Then in that scenario, whatever the income being earned will not be included, but if that income, suppose the tax rate was less than 9%, then it cannot have this option, then it has to pay the tax in UAE for the income earned in that Singapore and UAE, but of course the tax credit can be availed. So here is a scenario like, a company having a branch in Singapore in 2024. There was a revenue of 5 million and then expenses of 5.5 million, 500,000. So this loss of 2024, because company A in UAE has opted for a foreign permanent establishment benefit under the schedule where it will not tax the income of Singapore, or even the losses which is there in Singapore cannot be absorbed or set off from the UAE income. So the losses cannot be set off if you are taking this benefit of option of foreign permanent establishment exemption. And in 2025, if you see, if the gain which has come to Singapore, they will do set off of the previous income, a loss in that. So, and even this, whatever the gain which comes in balance will not be coming to UAE because the option was selected of exempting this foreign permanent establishment. Now, certain adjustments which are required in the accounting income, when you have computed the tax, where derived accounting income, what are the adjustments required? And you have to be mindful that certain items which are exempted or certain deductions which are not allowed. So certain exemptions are dividend and other profit distribution. Dividend, whether received by a juridical person, LLC company, or a resident person individually also, that is not taxable in the hand of recipient because that dividend is distributed from the profit, like BLLC in UAE distributing a dividend to his shareholders or even to the investors, then the recipient of that dividend from BLLC will not be taxable because BLLC is already paid the tax on the profit and it is distributed after the tax profit, after tax profit. Now, in case of participating interest also, any dividend being received or any gain arising from the disposal of assets, the capital gain, that is also not taxable. Now, what is participating interest? That you need to hold more than 5% or more than 4 million in the in another company like Singapore company. If you are having an investment more than 5% or 4 million, and that holding should be more than the holding should be more than 12 months. If you're holding it for more than 12 months, then you are eligible to become a participating interest, or any dividend that is declared by the Singapore entity in UAE, a recipient of UAE will not be taxable for that. Then income derived by a non-resident from operating an aircraft international, because this is eligible only when the similar benefit is given by other countries as well. Like Singapore also give this benefit of operating shipping line, and they're not taxing those income on the shipping line. Similar benefit UAE also gave that they were not going to tax by the non-resident making any shipping income. And foreign permanent establishment, I've already talked about that in the previous slide. Now, certain deductible expenditures. The first is that it should be wholly and exclusively for the business. And we have seen in our clientele sometime, generally they are claiming the personal expenditures when it is a promoter-driven company. They are not bifurcating with whatever expenditure they are incurring, like they're incurring expenditure for the children's schools or other personal expenditure. They just draw the amount from the bank and charge it off. But that should not be, that expenditure should be pertaining to the business. Maybe he's traveled for business purpose to Saudi or any other region, and that is mix. They attended certain business meetings and also had spent some holidays time there. So you need to bifurcate what was the expenditure incurred for business meetings and what expenditure was incurred personally during the travel. So all the receipts need to be maintained, and all the personal expenditure being incurred during the trip will not be eligible. So when you're preparing your financials, you need to be mindful of that. And the another is like, those expenditures should not be relating to an exempt income. So for example, dividend. So company A has invested in company B. Now you would have borrowed the funds from the bank and there's an interest element being paid for that. So the investment which has been done in B by company A, from borrowing of that fund where interest has been paid, so that interest amount will not be deductible because the dividend which is earned is not is an exempt income. So in case of an expenditure incurred on exempt portion of the income will not be deductible expenditure. And also on capital nature, anything which is of capital nature, like if your company is buying an asset of like car is being purchased, So the value of car which has been purchased, so it has been purchased for 100,000, the car value of the car is being purchased. So that 100,000 will not be a deductible expenditure, but the depreciation, that is whatever the depreciation is being charged, it will be charged in the accounting income, and that portion is allowed in the accounting. And so to the extent of only depreciation is allowed in the accounting expenditure, but not the full amount, because you are going to claim in the future period the depreciation for that. And other non-deductible expenditure, so when you're making your chart of accounts, these need to be careful, and then you have to classify your line items in your chart of account, so that you are able, it's easy for you to compute your tax liability based on that. So like donations being given, but donations only for qualifying benefit entities are eligible, or in case of, input VAT. Now input VAT which are eligible, like suppose for small value of generally for telephone or fuel, you might not be keeping a track of those 5% VAT which is recoverable from the business, from the output. Now those input which you have not claimed from your output, which you are eligible to be claimed, so in that case you cannot be reducing that VAT amount as an expenditure. So suppose 105 is the amount of telephone bill and 5 was not claimed from your output. So in your tax computation, you need to add back that 5 amount. That means that will be taxable. So you need to start keeping a track and create a separate account for the one which is not recoverable, so that it's easy for you to compute a tax liability. And any kind of bribe, payment, of course, is not a deductible expenditure. And entertainment expenditure is limited to 50%, and that is applicable only, in case of your shareholders, your partners incurring that expenditure. It includes all lot meals, accommodation, transportation, or any kind of admission fees being paid. That limit, it's limited to 50%. But when it comes to an employee, it is like eligible for employee related expenditure, it is 100% eligible to be deductible. Specifically when you have annual meet get together for an employees event, those expenditure are eligible for 100%. But in case of your shareholders, customers are limited to 50%, and those proper documentation has to be maintained that you are able to claim that amount. And similarly, any related party loan which is there, so then in that case, you need to be sure that the interest amount which is being paid, it is having a substance, it is for the business purpose, then you're able to eligible to claim it. And also there would be a transfer pricing concept applicable, which my colleague Prakriti will take it about that, need to be at arm's length, that interest amount need to be arm's length, that to that extent it will be allowed as eligible. And for net interest expenditure also, there's a limit of 30% of EBITDA earning before interest, tax, depreciation, amortization, or 12 million, whichever is higher. So if you're having 100,000, the limit is 12 million. So it's a big amount where you can see that most of it should be eligible to claim your net interest expenditure, but you can always carry forward, which has not been claimed, to next 10 years. And in case of any foreign income tax which is being paid is not deductible, you might be reducing it as an expenditure, like withholding tax until now could have been considered as an expenditure, but that now, so because you're going to get a credit for that, so it's not a deductible expenditure. So as I talk about, net interest expenditure is limited to 12 million, 30%, and includes all kind of expenditures, and it can be carried forward for next 10 years, or but total carry forward inclusive in a year cannot be more than 12 million. Now, another point which need to be, we might come across in your financials is that you have a debtors provision being created, and provision amount was reduced in your, while computing your accounting income. So suppose you have a provision in 2023 that you would have reduced it from your computation of tax of your accounting income in 2023, but you are going to receive it in 2024. So that reversal which is happening, even for the bad debts which you have done in 2023 was not recovered and you claimed as an expenditure, but you're receiving that bad debts or reversing in 2024, that become taxable. Now 2023 was not a taxable period, okay, but still that amount which you are receiving from 2023 in 2024 will be taxable. So whatever provisions you have, you need to see in your financials, whether that is properly accounted, and if you see the likelihood of receiving that, you need to be careful that that amount will become taxable in the future period whenever you receive that. Then unrealized gain and losses, as we have discussed earlier, that all those differential amount need to be adjusted in your accounting income to derive a tax liability. Your assets and liabilities, the land which I was saying about, or particular fair value changes, or but revenue items has no impact. Revenue item, where like inventory which is there, is a normal treatment, that whatever treatment has been considered in accounting income will be continue the same. So no adjustment will be done with that respect, tax computation. Now, certain business withdrawals which takes place, generally as an owner, they keep on withdrawing and they account in your current account. So those items will not be deductible expenditure. So you need to be careful that you might be putting or claiming that. And if those are not, these are personal nature, not for the business purpose, then those amount cannot be considered. So you need to keep a separate account. Maybe, if you want to, sometimes the owner want the shareholder want that whatever expenditure even they are doing for personal nature, they should be tracked. So you can keep a track as a personal owner's expenditure, but it will not be eligible to be deductible amount. So you need to, if it is considered in accounting income, you need to add back that amount for your tax computation. So you need to have a separate chart of accounts for those expenditures. The concept is with respect to the tax losses relief. The basic principle on the tax loss relief is that whatever losses, if you are having incurred in your tax period, now the first tax period is 2024. So any tax losses which you have carried forward from 2022, 23, or any period prior to 2024, that losses cannot be set off in 2024. So only losses which will be set off is from the period when the tax was applicable to your businesses. So those only, like, if you would have losses of maybe 100,000 pertaining to 2023, that losses carry forward in 2024 will not be set off in 2024. So only current year from the period when it is now, and this, it can be carried forward to unlimited period, and this is like up to 75% is the minimum limit, like is the maximum, it is the maximum limit up to which you can set off from the period. And the other clause is that, while you want to set off that loss, but the ownership stake of the business, like you had a garment business and there were two partners in that business, investors in the business, they should be continuing that business. Okay, the garment business should be continued to claim it. Like in 2024, there was A and B partner. In 2025, the same partners would continue and the business would continue. Okay, if even the partners changes in 2025, maybe like A discontinued and someone else is coming in, but the business would continue. Okay, to get a benefit of carry forward losses. So here's an example of that 2024 you had a loss of 275,000. The business has a lot of 275,000. Now in 2025 there is an income of 100,000. So up to 75% of that particular income is eligible to be claimed as carry forward losses. So 75,000 out of 275,000 of 2024 is set off in 2025, and the balance remaining from 100,000 is to 25,000 is the intake, which is not a it is below the threshold of 375,000. Now it's important that you may be thinking that my income is less than 375,000 in 2025, then why should I carry forward and set off in this 2025? But as per the regulation, you need to have the set off done. Even if it is less than 370,000, you might not be paying otherwise also. Without setting off also, you are not going to pay tax, but still you need to set it off and the balance can be carried forward. So it's you need to follow that principle to set it off in every year, irrespective you are not paying a tax, still you need to set it off. So, and it can be carried forward to unlimited period. And this is what I mean, to set up the losses, the basic period principle we talked about, say 75% common holding between the companies, and they should be following the same accounting period, same financial period, and none of them should be like A and B are the companies, and they should be both not in the qualifying free zone, because its qualifying free zone has a 0%, whereas normally we paid 9%. They should be paying same tax rate to be eligible to set off within the juridical person, and common stakeholding of 70% should be there. So here's an example, company A and B. The revenue of company A is 2 million and it has a loss of say 100,000. and there's a loss of 100,000 which can be carried for, there's a loss of 550,000. Now taxable income before loss, the tax loss is 550,000. Now this 550,000 can be set off from company B, but if you see the company B income is 600,000. So tax, the 70% of that is, the tax which is eligible to be carried for set off is 450,000 out of. So the tax 70% of 600,000 is 450,000. So that is the portion which can be set off by company A from its 550,000 loss. So the balance 100,000 by company A can be carried forward for future period, and company B will have a taxable income after 600,000 minus 450,000, 150,000. So, I mean, the purpose is this authority still want to have certain portion of income where they could be paying tax, depending upon whether it cross the threshold limit, but not complete 100% is eligible to be, as a deductible losses. Now, the next portion we are going to talk about transfer pricing, how do we define it, what kind of adjustments are required, and what kind of reporting would be required in your tax return. For that, I would invite Prakriti to take over this. So Prakriti, I will stop sharing and you may share your screen.
Sure. Thank you. Thank you so much, Manish, and thank you so much, audience, for having the patience and knowing more about the corporate tax. I'm Prakriti Dangi, Associate Director with SNP Consulting, and I am bring expertise of transfer pricing, having worked with PwC for about 8 years and overall experience of 12 years. So the major question comes to the mind that why transfer pricing has been introduced and what does transfer pricing mean? So let's solve this buzzword. So see, in case there are two parties which are related, and the related party might be defined by any of the jurisdictional tax laws in their own ways. We will also take you through the way in which the UAE corporate tax has defined related party. So what happens that in case a company A, which is a holding company, having a subsidiary company in another jurisdiction, and the major difference is that the tax rates are different. So if you see company A belongs to a country where the tax rate is 25%, whereas company B is in a jurisdiction where the tax rate is 15% or low, which is a no tax or a low tax jurisdiction. Then in case company A being manufacturer transfer its goods to its distributor group related company at an unrealistically low price, only because it has control over the pricing, and the other intention is to save on the taxes, which if it will sell at a higher price, it will pay probably a higher rate of tax vis-a-vis its distributor group company. So the transfer pricing comes into place to check on the controlled transactions where the pricing might be controlled because there are because of the influence that the two related parties might have to transact, and of course to avoid the higher tax liabilities. So now once transfer pricing comes into effect, which certainly means that the price at which, in our example, the goods are sold by the manufacturer entity to distributor, it is as if it transacts with any unrelated parties. So once this arm's length pricing is maintained, the impact is very clear that each of the jurisdictions get the tax for the value that is created in its country. Now, the actual market value to avoid the tax base erosion is also checked, and the overall pricing is aligned to ensure that profits are not artificially shifted to a country which has no tax or low tax jurisdiction. So let's see what is a related party as per corporate law, which is in the UAE. Article 35 talks about the definition of related party, where relationship comes out of kinship, ownership, or control. Kinship means relationship out of blood or a marriage or adoption, and it takes to the fourth degree of ascendants and descendants. So the scope of kinship is quite broad here. The next is ownership, where it talks about direct or indirect ownership, or a person who is holding common ownership between the two entities, all become part of the ownership criteria to say that the two entities are related. The threshold here is 50%. So if this ownership is more than or equal to 50%, the related party will get triggered. The third point is on the control, which is defined very broadly, but takes into account control, direction, and influence. So if a person has a significant influence in a business, then it becomes a related party by the control mechanism. A few examples are also mentioned in the law, which says that if there is a if you are in because of the control arising as in terms of voting rights, having capability to affect or uh, bring changes to the composition of the board of directors, having influence and sharing the profits of the business are a few parameters that comes under the control, but one has to look into the detail of the fact and the conduct of the parties to say that whether control is affected or not, so that a related party relationship can be drawn. The another term which is very specific to the UAE jurisdiction, which also affected as a related party, is the term connected persons, which means that a relationship between a taxable person as a result of ownership, interest, control, or exercising significant influence. For example, it is very clear that any owner or director of a company will become a connected person. However, there are certain other positions held by key managerial persons in the company which exercise significant influence and also make the decision making a key decision maker in the company, such as the director officers, the CEOs, and the other people in the senior managerialship. And that's why those become the connected persons. So once we have defined the connected party and connected persons and related parties, the question comes that what happens and how is this affected? Now, all the transactions that happens with the related parties and any payment or benefit derived by a connected person from providing the services in the company are under the net of related party or control transactions, where transfer pricing and arm's length determination is required. So we have an example where there is Mr. Ali in company A who owns the company, and there is Mrs. Ali who have significant influence in the company. Probably she's a director in company B. In now, by means of common ownership and indirect ownership, company A and company B, if they are having any transaction, they also become related parties. So Mr. Ali and Mrs. Ali, although are related by means of blood, which is kinship, their ownership and control in respective entities also make the other companies which they hold or control as the related parties. So there could be various transactions that related parties may enter into. One could be the transaction of buying and selling of goods, manufacturing, trading of goods. The other could be services, and which will have a very wide range, which could include very typically the management services, the administrative services, the strategic support that the company is provided. It may also include certain services that one entity of the group is having expertise into and the other group entity might need, such as facility management services, which is provided to a group company which is into real estate broking or property management. The other arrangements that are very important to understand is about the intra-group loans, where one entity is providing loans or guarantees or any kind of funding to another entity. And these also becomes a part of related party transactions, where it is important to understand what is the interest, and the interest should be at arm's length to say that the transfer pricing compliance has been met or not. Other transactions could be purchase, sale, or lease of tangible property, or even charging of royalty or license fees on any intangible property, or probably a sale or purchase of intangible property from one entity to another. Then we also have seen there are common costs wherein one entity is incurring costs on behalf of other group entities and probably not allocating. Or if they are allocating, they might not be charging. So even they need to charge an arm's length markup for those common costs. Depending on the nature, which we will take you through in our subsequent slides. So this is a typical example where arm's length pricing can be explained. So there is this company A, which is into facility management services, and it is a 100% subsidiary of a company B, where company B is into property management. However, company A is also providing its services, which it has expertise, to other customers, which are third-party customers in the market. So now what's important is who are the related parties. So clearly, with the 100% ownership, company A and company B becomes the related party. Question 2 comes, what are the related party transactions? So company A, which is providing facility management services in this example, is the related party transactions. There could be any other transaction between the group entities, but for now, for the sake of this example, facility management is the transaction, which is a controlled transaction. Now, how we need to determine the arm's length price. So before that, take a step back, and it's important to understand what's the current pricing mechanism which the group entities are following to determine to conduct the existing transfer or provision of services. And following that, it's important to see whether there are any internal comparables available. So in the current case, company A was providing services to B and company C. And in that case, the comparability can be done on internal comparable basis, maybe on a transaction by transaction basis or on operating margins basis. Having said that, in case company A was providing services only to company B, or there were certain other situations whereby even if they are providing services to third parties, but they cannot be compared because of the quantum or the value of transaction, then in that case, an external benchmarking and external comparability is recommended, where a database is used to capture companies which are into similar line of business, having similar functions, and then by doing a functional and an economic analysis, which we will again take you to on the later slides, arm's length margin is derived, which substantiates the price at which the transaction ought to have happened. And in case the transaction value, the actual transaction value and the arm's length value differs, then there is an adjustment which is required to be made. We would like to take you through with the intra-group services. So as I mentioned earlier, there could be costs which are common to entities. So there may be, for example, accounting HR services, which are probably support services which one entity is making expenditure and incurring those expenses. However, the benefit of those expenses are also received by other entities in the group. In that case, it's important to identify what are the transactions and what are the entities which are benefiting from them. The next task is to understand whether these are the pass-through costs. For example, if it is a third-party cost, it can be treated as a pass-through cost. However, a detailed analysis is required. The second category could be a low-tax, low-value-added services. As I mentioned, there could be services like accounting, HR, and so on and so forth. Those can be categorized as low value added services, where those services are not core income generating activities of the business or the company. However, it's supporting in nature and does not add, valuable intangible to the business. The third leg would be the core business activities. For example, the facility management services, the example that we took in our previous slide, those were the core business activities of the facility management business. And those will be categorized in the third leg of this services. And there, a specific benchmark or an internal comparability would be required to substantiate whether the prices are at arm's length or not at which the transaction has happened. Typically, for common cost allocation, there are two methods or mechanisms which have been for which the guidance have been provided by the OECD, which is the Organization for Economic Cooperation and Development. One is the direct charge method, the other, as the name suggests, is the indirect charge method. While any expenses which is to be allocated to the group entity and the mechanism for which is available directly. For example, if a software has been licensed by a parent company and all the group entities are using it, and the cost is based on the number of licenses used, then it can certainly estimate from the facts that what are the number of licenses that each of the group companies are utilizing, and that becomes a basis to ascertain the common cost that to be allocated to each of the group companies. However, there are certain expenses where it is impossible to identify what is the cost or what is the ratio in which the charge is required to be allocated. And in those cases, analysis of and fuller understanding of the transaction is required, and at the same time the allocation mechanism is to be required. Typically, OECD suggests allocation mechanism to be based on revenue, headcount, or based on expenditure, or based on square footage, and each of them could, and every company or every industry may have to use a different set of allocation mechanism, totally depending on what is the nature of services, and at the same time, what is the availability of data basis which the allocation can be made. So, having said that, it's important to have a robust documentation in place for all the intra-group transactions, including the intra-group services, whereby it is important that the actual conduct of the companies is matching with the contractual arrangement. At the same time, in case allocation is made, the rationale or the logic for allocation mechanism should be captured. The actual nature of services, the description, the recipient entities should also be identified very clearly in this documentation. Again, the arm's length price, if any, identified with the help of a benchmark, and the whole benchmarking exercise should also be documented in this. So it's a document that if you prepare on a contemporaneous basis, for example, if it pertains to 2024, it should be prepared within and before the filing of returns, so that once it's ready, anytime if the FTA asks for the information, that's very much handy for you to submit it to FTA. We talked about benchmarking in our previous slides, and it might seem an alien word to many. So this slide would take you through the steps by which the benchmarking can be conducted. The most important part here is identification of the related parties. So there would be ideally two parties in the transaction, or it could be a tri-party agreement as well. So identification of those related party becomes important here. Suppose that the value at which the transaction has happened need to be ascertained, and this is the value for the year under consideration. For arriving at the arm's length price, the law also requires you to use a most appropriate pricing method. The law has prescribed 6 methods, few of which are transactional methods, such as comparable uncontrolled price method, and there are certain methods which are very much which deals with the functional profile of the company and takes care of the operating margin as a comparable parameter or a profit level indicator of the company. Post identifying the most appropriate method and putting a rationale for selection of that method, the search for comparable companies begins, where external database has to be leveraged and which has details of million of companies from which a selection of the particular industry, the nature of services or goods, and other filters, other ratios can be put as a search criteria to obtain a set of companies where a detailed search can later be taken to oversee what are the comparable companies to my business, which is the tested party. Now, all these search process is required to be documented well, and then detailed qualitative and quantitative search filters need to be applied. While I say qualitative search, that includes looking at the financials of the company, looking at the information that the database provides, and also looking at the website of the company. So it's a very detailed and in-depth analysis which takes you through and gives you an arm's length pricing. Once all of this is done, you get the pricing at which the transaction should have happened. So you have the existing pricing at which you are doing the transaction. And now with the benchmarking, you probably also have the arm's length pricing. So a few databases that are there and also recommended globally are the TP Catalyst, S&P Capital IQ, Loan Connector, Royalty Stat, Provis, and Capital Line. Each of the database has their own benefits and are required for their certain transactions. For example, TP Catalyst is a global database and is suitable for any benchmarking where transactions are analyzed on net profitability basis. Whereas the Loan Connector database, as the name suggests, take care is again a global database and takes care of arm's length, arriving at arm's length interest rates on loan or guarantee rates. The other database which I'm talking about, Provis and Capital Line, are the Indian database and may required if one of the parties or the tested party is in India. Now talking about what are the important adjustments and disclosures that are required to be made in the return and even in the financials before you actually start preparing your return and you're closing your financials. So we have spoken about what is the arm's length, why the arm's length requirement is there, because there are two parties which are related, and then they are controlled transactions. The law looks at those transactions between the controlled parties as may have an significant influence over the pricing, and hence determination of arm's length pricing is required. What is a transfer pricing adjustment? So transfer pricing adjustment is a difference between the pricing that actually the company is currently following vis-a-vis an arm's length benchmarking price that has been arrived after detailed analysis. Now the question comes, now you have the amount of adjustment with you, how to deal it with. So there are two ways. And first is to take care of these adjustments in your financial statement. So now, as we all understand that the companies which are following the calendar year as their financial year, and they are now closing their financials, would be starting their audits. Now, this is the high time that all these transfer pricing adjustments are catered to in their financial statements itself. The other option is while you take care of these and make the transfer pricing adjustment in your tax return, if any adjustment is not made in the financial statement. However, it's important to understand that any upward adjustment made in the tax return is allowed by the FTA. However, in case of a downward adjustment, which I will take you through in the future slides, that any downward adjustment will be allowed only upon a successful application to the FTA. The rules for how and the procedure for downward adjustment is still not clear. However, this is what the law has spoken as of yet. While we talk about payments to connected persons, so any payment or benefit which is made to connected persons against the services that they have provided in the company, that will be deductible only to the extent that they match or they reflect the market value of the services or benefits. So what happens if the payment is excess of the market value? That gets disallowed in the return of income. Or you may adjust the payment in the financials as the case may be. So this is how upward and downward adjustments looks like. So there are two related party, company A and company B. And company A has a transaction with company B, which has an implication that after assessing the arm's length value, the taxable profits of company A might increase and subsequently the profits of company B will decrease. In that case, if the adjustment is made in the financials, it's very much allowable to make the upward, which is the plus, and the minus adjustment in respective entities. However, if you take levy of making those adjustments in the tax return, then upward adjustment, which has the impact of increasing in the taxable profit, is also allowed. However, as I discussed before, for any downward adjustment, which has the impact of decreasing the taxable profit, that will be allowed only when there is a successful application to the FTA in this respect. So it's important and very critical to make all the adjustments with respect to transfer pricing while you are closing your year end and completing and finalizing the financial statements. Now, what all is required to be reported to the FTA? What are the numbers that are required that the FTA wants to see? So the FTA has provided a threshold for the purpose of disclosing the related party transaction. Having said that, it also says that all the transactions with related party have to be at arm's length. However, disclosure is required only for certain high value transactions. And by high value, there are two criteria that the FTA has mentioned. The first is aggregation of total related party transactions entered by a company during a financial year or a tax year. If that exceeds AD 40 million during the year, then your tax return, you need to mention that my transaction exceeds this. And then if there are any adjustment vis-a-vis the arm's length price, the adjustments need to be mentioned in the return. However, if the next is if for each of the categories, the transaction exceeds 4 million, and we will discuss the categories later, the category wise transaction exceeds 4 million, then the details are required to be reported in the schedule, which are provided by the FTA in their guide for filing of corporate tax return. The other material threshold is required for the payment to connected persons, which is 500, mistake, it's not 5 million, it's 500,000 dirhams. So if the payment to anyone, even if there is one person and the annual payment to them is more than or it's exceeding 500,000 during the year, then a disclosure that is required to be made in the return of income. Understand? So the other disclosures or reporting requirement from a transfer pricing perspective is with regard to the local file, the master file, and the country by country report. Local file is somewhere required to be filed by an entity which are having its revenue having more than AD 200 million during the year, or if it is part of a multinational group, then the consolidated revenue, if it exceeds 3.15 billion, then in that case, a local file is required to be prepared by the person. Similarly, master file is required to be prepared in case the consolidated revenue exceeds 3.15 million if the company is a part of the multinational group and headquartered in the UAE. Now, local file and master file both are a documentation requirement, which is not mandatorily required to be attached in the tax return. Although there is a space in the tax return, but it's not mandatorily required to be attached in the tax return. However, the FTA has mentioned that these documentation needs to be prepared by the taxable person on a contemporaneous basis. So for 2024, you should need to prepare on time and not keep it on hold for future years. And the FTA may ask for these documents anytime. And once they ask, there is a time limit of 30 days in which you need to submit these documents. Similarly, there is a country by country report, which is again applicable to multinational groups where the turnover of the consolidated turnover of the group exceeds 3.15 million. So this is how the flow of reporting of transactions looks like. So once you have identified there is related party transaction, and then what is the value of transaction? If the aggregate value, the total related party transaction in a taxable person, if that exceeds 40 million, then what happens that it takes, if you say yes, then the tax return form takes you to a schedule where you have to fill the details of all the transactions with related party if for each of the category of transactions, the value exceeds AED 4 million. So for example, there are 4 transactions and the total value of transactions exceeds 40 million and you say yes to the question in the tax return. Then a schedule will open where you have to fill the details of related party transactions. For example, you have to put the name of related party with which the transaction has happened. You have to also mention the type of transactions, be it the goods, services, the IPs, interest on loans, other assets and liabilities. You also have to mention the tax residency, the TRN, if the transaction is with an entity in the UAE, or TIN in case the transacting parties or the related party is outside the UAE. It's important to say, to put that the value of transaction which is required to be reported for computing the thresholds that we have seen and also for the purpose of disclosing in the tax return has to be the gross value of transaction, and it cannot be netted off within the same party. So if you have 2 transactions with the same party, you cannot net off those transactions. So to minimize the impact of related party transaction, it has to be shown separately. There are 6 methods which have been there in the law, which is mentioned here, CUP, RPM, CPM, those are there. So these are the methods which you need to specify which particular method you are using to substantiate that the pricing was at arm's length. Once that's done, the value of arm's length price is also required to be mentioned. And in case there is difference, the tax adjustment has to be reflected in the tax return, which will again be added to your taxable income for the purpose of computing taxable income and have consequence on the tax outflow. For the purpose of payment of connected parties, it will ask you if the payment exceeds 500,000 during the year for at least one of the connected persons. If there are multiple, then also you select one, yes, and then you have to provide the details of the connected persons, their tax registration if applicable, what are the payments and benefits that you are giving to them. So it's just not restrict to the salary or the remuneration that the owner or director or the connected person is drawing here, but also the other benefits which typically in this jurisdiction happens that the connected person or the KMPs are provided the benefit of the accommodation, conveyance, and so on and so forth. So those description of the payment and the benefit is required. The amounts need to be quantified and mentioned in the tax return, and then a market value analysis of what is the market value of the payments which is being made to the connected person, and in case of difference, the adjustment has to be reflected and ported in the tax return. Yeah. So I think this was it about the transfer pricing. And if you have any questions, so this
Yeah.
please take
So
it over.
yeah, I think thank you, Prakati, for taking us through this. For the transfer pricing, I think the concept is, it's quite applicable for most of the companies having group transactions or connected party payments. But how that applies varies. So this is just a summary in terms of, when we look at the tax return structure, it is that, as I was mentioning about the taxable person, which is popping up from your corporate tax registration details and certain elections which need to be carried out, based on your analysis assessment of financials. So you need to assess your financials, that what all options you're going to select in your tax return. Then accounting schedules, which are your accounting income details, your profit and loss balance sheet that has to be uploaded and disclosed in your return filing. And then the adjustment which take place in computing your tax liability, which we discuss about deductible, non-deductible, and certain realization basis, and certain reliefs which are applicable for when you have a qualifying group having 75% common holding and any transfer of a capital asset taking place or liabilities transferred, then there is no gain and loss, or business restructuring or a transfer of businesses happening around, then there is no gain and loss, and certain adjustments which are there. And then finally, the the tax credit which is eligible when you have any foreign income, the tax which is being paid on the foreign entity, that tax is getting credited, you get a benefit of that, and then the losses which can be carried forward, and certain declarations which you need to do when you file the return. So considering all those disclosures which has to be done, accordingly you need to prepare your financials. Just next slide, which is basically what should be now the key takeaway in terms of course, make sure that whatever you updated in the corporate tax registration, if there's any change in your ownership structure or whatever has changed once you have submitted the tax registration, if anything has changed thereafter, you need to update, because when you're going to file a return, those updates will not be reflected and you need to go back, and it may take time for authority to respond. So better you just see changes which are happening in the restructuring or anything which has happened since the time you have applied for corporate tax registration, update those changes. And now of course when you're closing your financials, make sure that those adjustments which has to be done prior to closing your financials, or what has to be carried out after the closing, and adjustments in the tax computation, I need to be aware about it. And then assessing the overall elections, what elections or reliefs which need to opt, because when you prepare your financials, you need to see whether you want to go for realization basis or any transition rules benefit which you want to see, considering your business scenarios. You need to see an audit requirement in case which is more than 50 million, or they have presence in qualifying free zone benefit they're going to avail. For them the audit is mandatory, but still we recommend, because you need to submit your financials, you get your financials reviewed, and even then audit also for them, for you to be better prepared that whatever you're reporting in your financials is correctly reflected and your financials are in line with the IFRS reporting standards. And then of course the tax liability computation, which you need to consider in your provisioning for your financials. So you need to have that tax liability working, and then of course when you go and file for return, on the actual working takes place and thereafter. So yeah, thank you all. I think we have certain questions. We can take it up. Okay, so I'll just go up from the top, which I was looking at certain questions with respect to taxability. So there was a question by Mohammed Salah mentioning about, in case there is a DIFC company who is holding and a parent company, does it need to consolidate and prepare a separate financials? As I was mentioning, it is depending upon whether you want to form a tax group. If DIFC holding company, of course, will have a subsidiary company. Then in case they want to report as a tax group, then in that scenario, of course, the individual companies, subsidiary company need to prepare their own standalone financials, and for tax reporting purpose, they need to consolidate their financials and upload in the tax return filing when they become eligible for the tax grouping, that is 95% common stock holdings would be there by the parent company. Then in case by Sarath mentioned the question that if he runs a business in Dubai holding a golden visa, how is it taxed if it stays less than 180 days? Yeah, so as I was mentioning, in case of even a non-resident, now when you stay, don't have a tax residency in UAE, and you be categorized as a non-resident, even you are running a business in UAE, you still have to be registered. Now, depending upon whether it is as you're deriving a UAE source income. So whatever source of income is generated in UAE, it will be taxed. And if it is a dependent agent business or whatever form of business you're running in, that will be required to be registered and taxed in UAE. Then yes, I think Prakati maybe take up the question is regarding the TP disclosure. Of course, she has mentioned about it. One question is regarding by Sudha Ashok mentioning that payment of managerial remuneration, is there any guideline for determining arm's length principle, since the information of managerial remuneration is not publicly available and comparable for companies?
True.
So yeah,
True.
Prakati.
So, Daji, you're right that there is no publicly available comparable companies, list of companies for connected persons, but it remains same for other related party transactions. There is guidance available to determine the arm's length pricing, and a benchmark can be required for determining the arm's length pricing. Having said that, qualitative documentation of the roles, responsibilities, and why the payment made to the connected person is so, what is the basis for deriving the same, should be captured in a document, so to say that this is at arm's length. The
Yeah.
next question is by Mayur, who says that two related party entities incorporated in UAE sharing common office expenses is markup required to be charged. So as I mentioned that the expenses needs to be assessed in the category, whether this is a pass-through cost, whether it is a support service, or whether it is a core income generating activities. And basis that we need to see. So for pass-through cost, there is no markup required. However, for support services and for core income generating activities, certain markup needs to be assessed, basis which the charge should be made by the provider entity.
There's a question by Narayana Agarwal, I think, regarding the okay, if a juridical resident person is eligible for qualifying free zone person, but elected for a small business relief for the year 2024 due to turnover is under 3, can the company elect for qualifying? No, I mean the small business relief is not applicable for qualifying free zone person benefit and M&E because anyway they're crossing the limit. So yeah, I mean if he want to opt for qualifying free zone person benefit and so he cannot opt for small business relief. It's yeah, it is only applicable because they are anyway going to pay 0% tax when they get eligible for qualifying free zone. So need not go for a small business, and that is also not eligible.
Yeah. The next question is by Joy Ann, who says that do we need to consider transfer pricing for intercompany funding? Yes, of course. All the intercompany funding, whether it is a working capital loan or whether it is a long-term loan, or in fact where there are any outstanding balances which are outstanding for more than reasonable period of time, which generally the credit period allows for, the business allows as a credit period. In that case, transfer pricing comes into place and interest need to be charged, and there are benchmarking exercise and specific databases available where benchmarking can be done. So yes.
Yeah, and it's important, I think, because you actually mentioned that we might see some receivables and payables in the books, which is outstanding from the group. So you might not have charged any kind of interest until now because there was no transfer pricing concept. But now with 2024, so whatever balance, even like 1st January 2024 balance is opening balance. You need to have that arm's length adjustments, and that arm's length adjustment is with respect to the interest amount which should be there. And if it is outstanding more than a reasonable period based on the credit period the company follows. So therefore the balance which is as on 1st January 2024, there need to be an interest element added as an arm's length adjustments.
Yeah. The next question is by Vishal, who says that managerial remuneration provision is allowed at deduction. So see, yes, managerial remuneration is allowed as deduction because it's a genuine business expenses. The only check is if in case the payment is made to a connected person. So if those managerial person is also qualified as a connected person, in case any expenses that is within the arm's length limit of the payment made to them is allowed as deduction. However, in case the actual payment exceeds the arm's length value, the excess gets disallowed in the tax return. Yeah.
I think yeah, the important I think there's one more question, but just to adding to the manager, which I think is very critical because most of the companies which are promoter driven, owner driven company, they want to draw something as a salary which they were not drawing until now because it's just drawing the dividend or profit, but now it's getting taxed in UAE, so they need to have that the deriving that what is the arm's length amount which need to be derived, shown as a managerial remuneration, and the principle need to be followed is as Pragati was highlighting about that the basis should be considered, and considering the net profit benchmarking has to be done, or they need to consider the other agencies which are there provide what is the market rate, and functional analysis has to be carried out, proper documentation has to be done to be eligible for that.
Yeah.
I think there is one question from Matthew, which mentioned that for early revenue stage startups, how to calculate allowed managerial remuneration under the arm's length. I think irrespective whether it is new company or old company, the principal, I think maybe you just want to highlight anything on that, Prakriti. Does it
Sorry,
make a
I could not
difference?
see the
And
question.
no, because it is directly sent to me. The question is that for early revenue stage startup, that is a company which has recently been formed,
Okay.
suppose in October 2024, and then
Yeah.
and the company which has been running for like 2021 or quite old company, does it make a difference in terms of doing an arm's length for managerial remuneration for both companies?
So, irrespective of whether it is a startup or for which period it has been incorporated, if the payment exceeds 500,000, the payment to connected persons need to be determined at arm's length. Now, it may happen that you would have a documentation to say that these are the qualitative reasons that my company has started now. It will have an investment for like first 1,000 days where there is no accrual of profits. I don't see a profit happening in my company. But then you need to find certain comparables which are similar in similar line of business where there is no turnover for a first few years. It's a startup, so you need to make a comparison with those industry. Having said that, there would be other industry reports available which could form part of the documentation report, so to say that although there are no profits, however the managerial remuneration is there. But in each of the cases, it should not be very overwhelming of a number that the FTA may come and question you.
Yeah, thank you. The another question is from Nihal. If a UAE company having subsidiary in Qatar where they pay tax, where they okay, yeah, they're paying tax in Qatar. So does it get a tax credit? What benefit is eligible for them in UAE if a POEM is established? Yes, I think the first important thing is to see whether you have a place of effective management in UAE for that subsidiary in Qatar. The directors or the key decision maker, strategic decision maker are sitting in UAE for that subsidiary company of Qatar. In that scenario, yes, POEM will be established. We need to assess certain other criteria, documentation to see about it. And if it is established that the POEM is there, then the income which is earned of subsidiary in on Qatar get taxed, but then you get a tax credit of whatever been paid there in Qatar, that the tax credit can be availed, and also DTA agreement can be looked into if we have with Qatar.
So next question is about the threshold for doing the benchmarking for payment to connected persons. So you have to see in a way that what is required to be disclosed in the tax return is the payment exceeding 500,000 per connected person per year. And in case if does not happen, if the threshold is not crossed, the ideally it should be at arm's length. However, there is no you may keep a documentation to support the payment if it is not very high or just on the threshold. Probably we recommend this in case of a listed company, even if the threshold is not crossed. However, benchmarking probably not be required. It's not required to be reported in the tax return. So that's the interpretation that we do.
Yeah. Okay. I think yes, we had looked into all of the questions which are there. So if anything still there, we will anyway be sharing this presentation to you guys. Those who have not shared their details, I mean the forms, and we can fill up the link form which we shared earlier to participate in this webinar. You can share your contact details, just direct to me, and I will be sharing this webinar through email or whatever number you share. We will share this webinar link to you guys, which can be referred later on. And below are my contact details in this screen, and you can contact me for any further query or you want to clarify on any particular topic and on any kind of business scenarios you want to discuss about it. We can happy to help you on that.
All right. Thank you so much being here and listening to us, being patient. We'll be back maybe with another session next month. And till then, thank you so much. And in case you have any queries, any business related issues, do reach out to us. Thank you so much.
Thank you all for being part of the today's session, and I'm sure each webinar gives you some learning, and it's the more you attend such kind of webinar, it will help you to to build up your knowledge base on this. Thank you so much.
Thank you.